Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial secrets of the business world. And today, folks, we are diving headfirst into Gloo Holdings Incorporated's latest 10Q filing. And let me tell you, it reads like a chapter from a tech company's wild roller coaster ride. Stick around as we decode the numbers that show Gloo's rapid expansion, the risks they are taking, and whether this faith tech company is truly building a sustainable future or just riding a wave before it crashes. And before we dive in, if you appreciate getting the real scoop from these dense financial reports, make sure you are subscribed. We also have a Discord community linked in the description below where you can connect with us and other corporate sleuths. Alright, let's cut through the noise. This is Gloo Holdings Incorporated's Form 10Q, a quarterly report that gives us a snapshot of their financial health for a recent period. Think of it as their progress report card, and boy, have they been busy. This filing tells us that by late 2025, they had a lot of shares floating around. We are talking about over 10 million shares of Class A common stock and a whopping 70 million shares of Class B common stock. That is a lot of ownership slices in this company. Now, let's get to the heart of the matter, the numbers. Looking at their balance sheets, which are like a company's financial snapshot at a specific moment in time, we see some dramatic shifts. On the 31st of October 2025, their total assets shot up to over $200 million, a significant jump from about $120 million at the start of the year. This really highlights Gloo has been aggressively expanding, likely through those acquisitions we see mentioned throughout the report. On the flip side, their liabilities have also ballooned. Accounts payable, which is money they owe to others for services and goods, jumped from about 3.6 million to over 9.2 million. This is a significant increase and often means they are buying more supplies or services to support their growth. But it also means they have more bills to pay. And speaking of bills, their long-term debt has nearly tripled in less than a year, soaring from about 67 million to over $162 million. This is a huge increase in borrowed money and tells us they are heavily relying on loans to fund their operations and acquisitions. While debt can fuel growth, it also means a lot of interest payments eating into profits. Moving on to how much money they are actually making and spending, their income statements paint a picture of explosive growth but also significant losses. Total revenue is the star of the show here. For the 3 months ending in October 2025, their revenue was over $32 million, a massive leap from just over $6 million in the same period in 2024. And for the first 9 months of 2025, they rocketed to over $61 million in revenue compared to about $16.7 million in 2024. That is a huge jump, suggesting all those acquisitions are really starting to pay off in terms of bringing in sales. Their platform revenue alone jumped from about $6 million to nearly $20 million in just 3 months, and from $16.5 million to over $37 million for the 9-month period. This is their core business, and it is clearly growing. But where we see the most dramatic change is in Platform Solutions revenue. It went from a mere $36,000 to over $12 million in just 3 months, and from $157,000 to almost $24 million for the 9-month stretch. This category, which Gloo says includes technology development and marketing services from acquired companies like Midwestern and Servant, is really driving their top-line growth. It looks like their acquisition strategy is working to add new revenue streams. However, all this growth comes at a steep price. Their operating loss for the 3 months ending October 2025 was over $26 million, a big jump from the $12.7 million loss in 2024. And for the 9-month period, the operating loss shot up to over $73 million from about $39.5 million in the prior year. So, while they are making a lot more sales, they are also spending a whole lot more to get those sales, leading to bigger losses. And remember that massive debt increase we saw earlier? Well, it is showing up here in their interest expense, which jumped from about $1.7 million to over $6.3 million for the 3-month period, and from $2.8 million to nearly $12.4 million for the 9 months. This is a significant financial burden growing with their debt. Now, things get a bit complicated with a loss of over $9 million from changes in the value of their financial instruments in just 3 months. This is a non-cash item, but it shows the volatility in their financial dealings and likely relates to those complex debt instruments with embedded derivatives we see mentioned in other notes. It contributed to a net loss of nearly $39 million for the 3 months ending in October 2025, and a staggering $110 million loss for the 9-month period. Let's look at what they own. Their intangible assets, which include things like brand names and customer lists acquired through purchases, have grown dramatically from about $11.4 million to over $31.9 million. This shows that a significant part of their growth strategy, as we might expect from a tech company, is buying other businesses and valuing their intellectual property and customer relationships. And closely related to that, their goodwill has exploded from around $27.9 million to over $93.7 million. Goodwill is what is left over after you buy a company and assign values to all its identifiable assets and liabilities. A big jump in goodwill usually means they have paid a premium for acquisitions, expecting future benefits. However, it is also a number that can be easily written down if the acquired business doesn't perform as expected, as we saw with the $27.8 million goodwill impairment charge related to their Outreach acquisition in fiscal 2024. This is a classic sign of aggressive acquisition growth, where the company is betting heavily on future success. Now, even the most exciting growth stories have their dark clouds, and Gloo does not shy away from listing them in their risk factors. They admit they have a limited operating history with scaling their platform, which makes it hard to predict their future. They also frankly state they have a history of net losses, and there is no guarantee they will ever become profitable. One of the most crucial risks they flag is that they identified material weaknesses in their internal control over financial reporting. This is a serious alert, meaning their systems for tracking and reporting financial information are not as robust as they should be. They mention issues with it: general controls, segregation of duties, and financial close processes. This is a red flag for investors, as it can lead to inaccurate financial reporting and potential fraud. They are working on fixing it, but it is a significant challenge. Another big point is that their co-founder and CEO, Mr. Beck, along with his affiliates, control a hefty chunk of the voting power. This means our other stockholders have limited say in big company decisions. While this can provide strong leadership, it also means minority shareholders have less influence. They are also heavily investing in AI technology, which they see as a major opportunity, but they also acknowledge it comes with operational, financial, and reputational risks. This is a common theme for tech companies right now, betting big on AI but aware of the dicey territory. They highlight regulatory uncertainty, potential intellectual property issues, and the risk of generating flawed or harmful AI content. Perhaps the most stark warning comes in their going concern assessment. They admit that their continued existence as a business hinges on achieving profitability or raising more money through financing. This is a significant statement, indicating substantial doubt about their ability to meet their obligations over the next year without further funding or a major turnaround in their financial performance. Looking at the net loss figures, they lost almost $39 million in just 3 months at the end of 2025, a sharp increase from the $13.6 million loss the year before. For the 9-month period, the loss was over $110 million compared to about $41 million in 2024. The sheer scale of these losses, even with booming revenues, is a major concern. They also highlight IPO-related costs, showing they spent over $3.6 million on preparations for going public. This is a significant expense that hits their bottom line. Let's talk about the big picture. Gloo operates in a very competitive space, from church management software to broader marketing platforms. They face competition from established giants and niche players. Their strategy seems to be a land and expand approach through acquisitions, aiming to be a one-stop shop for faith-based organizations. The rapid revenue growth suggests this strategy is working to some extent, attracting more customers and partners. However, the massive increase in debt and ongoing operating losses raise serious questions about sustainability. They are essentially fueling their expansion with borrowed money and are burning through cash at an alarming rate. While the IPO in November 2025 brought in a significant amount of cash, the report clearly indicates that profitability is still a distant goal, and they are heavily reliant on future financing. You can see the sheer amount of debt they've taken on, especially the nearly $139 million in senior secured convertible notes, is a ticking clock. The material weakness in internal controls is also a significant concern for a company that has just gone public. Having such fundamental control issues could undermine investor confidence and attract regulatory scrutiny. It suggests that their rapid growth might have outpaced their ability to build robust internal processes. In my opinion, Gloo is in a high-stakes race. They have identified a large, underserved market and are aggressively pursuing growth through acquisitions and AI development. The revenue numbers are impressive, showing they can indeed grow their top line rapidly. However, the financial health is precarious. The massive debt load, persistent operating losses, and the noted internal control weaknesses paint a picture of a company taking on a lot of risk to achieve its ambitious goals. They are successful in acquiring revenue and customers, but the path to profitability is long and uncertain. I'd be watching very closely to see if they can manage their debt responsibly, and, more importantly, if they can fix those internal control issues to build lasting investor confidence. It is a high-risk, potentially high-reward situation, but right now the risk seems substantial. Alright, that is our breakdown of Gloo Holdings Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Are they a visionary tech company poised to dominate or a high-growth gamble? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord in the description where we can continue this conversation. Thanks for watching. See you next time.